Welcome. My name is Dirk Brounen. In this short research clip, I would present to you the key results of a research project with the title The Return Effects of Introducing and Shifting Tax Regimes. This is joint work with Ronald Milieu and Hans op het Veld. Let me start with what is a REIT. The REIT Standard is short for Real Estate Investment Trust, and it's a tax facility. Property companies can take the REIT Standard in many countries nowadays, as it has become very popular both across Europe, as you can see in the picture, but also in Asia. The REIT Standard originates in 1960 in the United States, and what it does is it introduces firms the choice of a trade-off. You'll get a tax exemption on the corporate level. You don't pay corporate taxes on your benefits, on your earnings, but in return you'll have to obey rules. 3 important rules, in fact. All the earnings need to be paid out as dividend, or almost all the earnings. You can't take every corporate action anymore. You can't take, for instance, real estate development activities in your company. And your capital structure is limited. The debt ratio is maximized. Now, why does a company, or a country in this case, introduce a REIT regime? Well, there are some effects that policymakers have been hoping for if you read the literature, and professional and academic. The first one is the investor base. Policymakers think that a REIT, as a standard, will attract more small retail investors than just merely the institutional investors. But also liquidity-wise, this increase of retail investors will also increase the stock turnover. There will be more liquidity. At least that's the expectation. As I explained on the risk level, the criteria are designed to reduce the risk of the company. And then finally, for some countries, like in the UK, we find that there's a motive to attract extra capital flow into the residential market. So hopefully a REIT market that is lively and very valid in the market will also attract extra capital flows into the residential market. But is this the case? Well, that is the question that we try to answer here. We do that in an international setting. So we're going to look at 5 markets: Japan, Singapore, France, UK and Germany. And between brackets you'll find the years of inception of the REIT standard in these markets. We want to see and diagnose whether the effects that policymakers hoped for have been also yielded in the market. Let me give you a short preview of the key results. So the REIT effects on a firm level, as you can see in the red bars, after a firm converts into a REIT, they have a higher dividend yield and they also have a higher turnover. So both liquidity and also the dividend yield effect have been reaped in the market. The blue bars are the same aspects of the firm, dividend yield and turnover of the same firms before they became the REIT. If you look at the debt ratio, the capital structure, but also at the closely held shares, and that is the dispersion of share ownership, we don't find any very pervasive effects. The blue and the red bars are more similar, and in fact we find mild increases of both instead of a reduction. But what does this do, the REIT effect, to the return and the risk of the stock? Again, in blue and red, we find any effects if they are present in the market, in this case the UK. In red, we'll find the firms that became a REIT eventually in the UK, and in blue you find in the same market companies that didn't become a REIT, so they didn't convert. You'll see that there are differences in risk and return, but you also can see that that is also the case before the REIT was introduced in the market, in this case 2008. So whether this is an effect due to the REIT or not, we can't establish from this graph. For this, we take the next step, an asset pricing test. We look at alpha and beta as measures for risk and return, and we're going to see whether the change into a REIT has led up to a distinct and significant change in risk and return. For beta, I marked the fact that a lot of companies in the sample, in this case again UK, have indeed seen a reduction in beta, a lower risk, after the REIT was introduced. And the bottom line of this table, you'll find the Chow test result, which is a similar test, significantly a change in both the return and the risk. Now, what are the conclusions then? Well, first, the REIT effect and the standard have become very dominant across the globe. In all 3 big continents, we find that the REIT is becoming very dominant in the listed real estate markets. And the effects that they have had in the market are also as expected to some degree. At least the dividend yields and the stock turnover increase alongside with the design of the criteria. We don't find this effect for the stock dispersion, so there are not more stockholders. And we also don't find a big effect on capital structure. If we look at stock return and risk, we'll find that in 46% of cases, there is a significant change in the risk and return. The Chow test shows this significantly. And in 58% of cases, we find that firms have a reduction in their systematic risk, the beta. This effect is not everywhere all the time. It's mostly in firms that are in countries that had very loose regulations before the REIT standard was adopted, which also makes perfect sense. If you want to see the full detail of our results, please go to the web link listed below. Thank you for your attention.